Let us move forward to a few things that the Roth TSP is not. Again, this is coming straight from helping individuals and from training events that we hold. The most common questions we get. Number one, you cannot convert your existing TSP to Roth TSP. While the Jobs Act allows for that in 401ks, the TSP board has not adopted that privilege. So if you want to get your existing TSP into Roth, it has to come out of the TSP and go into a Roth IRA. Making sure you understand that that option is not available to you currently inside of the TSP. Second, it's not all or nothing. Let's say you're contributing $20,000 a year to the TSP currently, and you like doing some Roth but don't want to do it all. You can contribute $10,000 to the traditional TSP like you're doing, and $10,000 to the Roth TSP, summing the $20,000, and that's fine. You don't have to put all of your eggs in one basket or the other as you're contributing money every pay period. You can't double up. You don't get the privilege of doing $24,000, let's say, into the traditional TSP and another $24,000 into the Roth TSP. You only get one $24,000 a person. But you can blend between the two tax strategies. Next, for Fers employees, the employer match will always go into the traditional bucket. Now this is a little tricky. Make sure you follow my point. Let's say for a moment that you're only contributing 5% to the TSP, and all 5% is going into the Roth TSP. The government will still match your 5%, but it will go into the traditional balance, not the Roth. Make sure that's a clear differential. You do not have to contribute 5% to the traditional TSP for the government to put their 5% into the traditional TSP. Great. That's a good point. You don't have to do that. Next, there are required minimum distributions on everything inside of your TSP when you turn 70 and a half. Okay? In a Roth IRA, there are no required minimum distributions. That's a different. We'll use the term RMD for discussion purposes as we go along here. But that's very important. If you do not need the money at 70 and a half, the government forces us to take what's currently 3.65% when you're 70 and a half from your IRA or from your employer-sponsored program, your TSP, and you have to draw that amount out whether you need it or not. The Roth TSP is not exempt from such requirements, whereas the Roth IRA doesn't have that same forcing mechanism. You can leave it tax-free as long as you live under current law. So that's what the Roth TSP is not for just a moment. Now, just for fun, for the sake of math, I'd like to show you a couple of case studies. Our first case study, let's assume you're contributing 10% of your pay to the traditional TSP, and you're getting a 5% match as a Fers employee, which again goes into the traditional TSP. You see my assumptions on the screen, $75,000 worth of pay, 2% pay raise every year. I'm not here to guarantee a 2% pay raise. I know that didn't happen this past year, but we have to make some kind of assumptions for spreadsheets. Also, I'm not guaranteeing 4% earnings. I just have to have some number to give you the concept that we're laying out here. We assumed a 25% tax rate both now and in retirement. Stay tuned, more on that tax discussion in just a few moments. And a beginning balance of $150,000. When we plug those numbers into a spreadsheet and we look out to say 2023, let's pick that as a retirement year for someone or a time in which you begin to draw money from the account, you would have gathered $337,000 in your TSP with those assumptions. Now we have one problem. That $337,000 is not yours. It is, and again, I'm in Middle Georgia, so I can get away with saying what I'm about to say, it is y'all's, meaning yours and the government's. It is a partnership, an agreement that you will pay your taxes later inside of that TSP. So if we assume 25% tax, now again, for this discussion, we are assuming that you drew money out over an extended period of time to maintain that 25% tax rate into the future. You couldn't take all of your money out and only pay 25% on the dollar on such a large amount in 1 year. But if we assume that tax rate, your after-tax money would actually be $252,000, not the $337,000. A substantial difference. Again, that's the tax money that you deferred while employed and didn't pay while it was growing, but paid it on the distribution side. Okay, so that's current situation. Have that number in your head, 252,000 in growth on the TSP for the traditional side. Now let's switch the story. We said 25% tax, right? Well, let's only contribute 7.5% to TSP as opposed to the 10% we were just contributing, but all 7.5% goes to Roth TSP. So follow my math for just a moment. If your tax rate was 25%, instead of 10%, let's do 7.5%. So we're actually not changing your bring home pay. The money in your pocket will probably stay the same with my little example here. If you could contribute in half percentages to the TSP, making this math work, 7.5% contribution would allow you to begin to build a Roth account. Same assumptions that we had just a moment ago. TSP's got 150,000 in it. Roth starts out with 0. What we'll find on the next slide, your eyes can slip to the bottom number on this slide. It's the exact same number, 252,000. If taxes are the same for you now and in retirement, then you don't save any tax money by waiting or by switching to Roth if taxes are the same for you. But what you do have, let me give this fundamental piece, you do have a differential in the way your money is saved. In this example, you now have both tax me later money and tax-free money, which will give you more control, more flexibility, more diversification of your tax planning in retirement.